John, price earnings ratios have been a very key fundamental for valuing stocks going back decades. First off, just to explain it for those who don't know, price to earnings, what does it mean exactly? Why is it important?
Sure, let's say company A is valued at $100 a share and it makes $10 a share. You divide $10 into 100 and it gets 10 times. And so the price earnings ratio, the price of the company divided by its earnings is 10. And it's kind of a throwaway that investors use to say, well, that company trades at 10 times earnings and this one trades at 12 times earnings, so the 10 times is cheaper. It's really a matter of saying, how much money do you need to pay to buy a whole company and get paid back all the earnings and profits? And if it's 10 times, it's 10 years.
The Federal Reserve, many will argue, has really distorted the market since the financial crash, and especially now with the pandemic and all these programs that it's brought out, where, for example, certain companies maybe would have gone under and died, and they're not because of all the money sloshing around and people investing in stocks. So in this environment, do price earnings ratios matter as much as they have historically, or can you almost discard them?
If you buy a company for $100 and it makes a $10 in profit, you're making 10% in your money, which is pretty good. But if the alternatives are 0.5% interest rates, 10% is enormous. So you could argue that, okay, if I can make 10% in this company, I should be paying a really high multiple of those earnings to get it, because my alternative, 1% interest rates, is lousy. So you know, what might have been reasonable at 10 times earnings, a 10% return, and now you might pay 20 times earnings, and that's a 5% return.
So they're still
pretty good.
PE ratios are still very important. They've just morphed and changed.
Yeah, they're just different valuation yardsticks that we use today at with 0% interest rates than you do when you can make 5% in the bank. If you can make 5% risk-free, why would you invest in companies that are only yielding 10%? Because there's a great deal of uncertainty. But if interest rates are only 1%, then 10% returns look really, really attractive in stocks.